Hello, my name is Michael Myers with Mutual of Omaha Reverse Mortgage. Over the next couple minutes, we're going to go through a little PowerPoint presentation where we're going to talk about, in general, what is a reverse mortgage, and then I'll be working towards dispelling the common myths. Before we jump into the material, I thought I'd give you some of my background. I'm originally from Des Moines, Iowa, and I attended Arizona State University for my undergrad work, and then I followed up with University of Iowa Law School. And so what brought me out to the West Coast to Washington State was I served 4 years in the U.S. JAG Corps, U.S. Navy JAG Corps. So no, I did not fly jets, but I had plenty of great law experience and met some lifelong friends. After my 4 years, I opened my own law practice in downtown Seattle, which was going great until one day in 1998, my little brother, who was in the mortgage industry, called me from his Corvette convertible and enticed me into that business. So I started doing regular mortgages from 1998 for the next 8 years or so. And in 2006, I found the light and started to do reverse mortgages only. And I love what I do. I've had some success. I've been in the President's Club several times, and I've assisted hundreds of people with their reverse mortgage needs, families with all kinds of situations. And so I really love my job. I think the only job I liked better was one summer during undergrad. I worked as a construction worker in Boston, and I really liked that job. But this comes a close second to that. Whether you're considering retirement or currently in retirement, we often talk about the three L's: longevity, lifestyle, and liquidity. I'm sure you're aware life expectancy is getting longer and longer, and we need to know that we have enough money to access to meet our basic living needs. How do we do that? Well, we also want to keep up a particular lifestyle, especially early in retirement. Those are the go-go years. We want to be able to maintain a standard of living that we're accustomed to, maybe even enhance it a little bit. Reverse mortgage funds can assist with that. And then last is liquidity. There are times where you really need to get into some funds, and to be able to access a reverse mortgage line of credit in times of need is a great way to do so, because you can draw that money out without any tax consequence and never have to make a payment as long as you live in the property. Reverse mortgages didn't start with Henry Winkler or Tom Selleck. In fact, there were reverse mortgages back in the 1970s, and those were the early versions that really actually had a lot of negative consequences for a lot of seniors. So in 1987, the federal government got involved in reverse mortgages, and they created the home equity conversion mortgage, and it was passed in 1988. The first one was actually done in 1989. There's been many changes to the program over time, but the basic tenets are the same. And it's a way to access home equity without having to make a mortgage payment as long as you live in the property. And we're going to talk in more details in just a couple minutes. Before we dispel some of the common myths surrounding reverse mortgages, I'm going to spend a couple minutes talking about what is a reverse mortgage and what are some of the uses and benefits. A reverse mortgage is simply a mortgage, but it is relegated to people who are 62 and over, and it allows you access to the current equity in your house to draw out for a number of reasons without having to make a mortgage payment as long as you live in the property. And so you never give up title to the property or are required to make monthly mortgage payments, although you're perfectly entitled to. Not only must you be at least 62 years old, the home has to also be your primary residence. That's the case in most individuals, but it cannot be a second home or an investment property. It was really intended to help retirees stay in their homes as long as they possibly could without having to make a payment. You do have certain responsibilities, and that is to keep your house in good repair, pay your taxes on the property, homeowners insurance, and HOA dues if you have them. The benefit, which is the loan amount, we call it a principal limit in the reverse mortgage, is based on the age of the youngest borrower or non-borrowing spouse. So we may have a spouse under the age of 62, and we'll base our loan decision on his or her age. The older one is, the more money they actually qualify for based on the same value property. So we are going to do an appraisal on the property, and then we look at today's interest rates, which are good. In the last 20 years more, we have not seen our rates in double digits, which is great. How you receive the benefits can come in any number of ways. First of all, we have to pay off any underlying debt. So if you have a current mortgage or line of credit or both against your property, we do have to pay that off. We have to be in what they call the first lien position. So once we pay off current debts, we often wrap in the costs, and then what's ever left over can be taken out in a number of ways. You can ask for some funds up front. You can arrange monthly payments to come to you for as long as you live in the property or for a set period of time. And you can even reserve a line of credit from which you can draw from in the future. The nice thing about a reverse mortgage is it's very flexible. So even if you set it up one way, once the loan is in servicing, you can request a plan change down the road. So it's a very flexible program. Some of the benefits of a reverse mortgage are listed below. It's really what we consider to be a low risk loan. When we set our loan amounts, the principal limits in the first time, we're very conservative. We never go close to the current fair market value of the property because we know if you never make a payment, which most people don't, that loan will grow because we're going to add interest and a small amount of mortgage insurance to that loan amount every single month. So in most cases, the vast majority, there is still some equity preserved. If you sell the property, you can walk away with the difference. Or if you pass away, your family only has to pay back what's owed. But the protection is you will never owe back more than what the value of the property is at the time you leave the property. And that's when the loan becomes due, is when the last borrower leaves the property permanently. So the funds that you receive from a reverse mortgage, they're not taxed. It's a return of your own equity. So even if you set up a monthly payment that's $1,000, $2,000 to come into your bank account every single month, that money is not income. It's just a return of your own equity. You can use those funds however you choose, as long as it's legal. There's no prepayment penalty. So if you decide to make a payment, that's perfectly fine. And I've had plenty of folks who are still haven't retired yet, but they put the reverse mortgage in place. They paid off their existing loan, and they thought, you know what, as long as I can make a payment, I will. And at any point, they could stop making a payment. So there's no prepayment penalty. Even when it's paid off at the very end, there's just none. This line of credit is a fantastic thing because not only is it guaranteed at the amount that we established it at, but it has a growth factor so that every single month we are going to increase the availability based on the same interest rate and mortgage insurance that is being applied to what you already have used. And you know, these are details I don't plan to get into too deeply here, but I urge you to contact me to learn about that growing line of credit because that's a fantastic thing. And when the loan does become due, you will never owe more than its home's value, and that's the non-recourse aspect of it. So in that case, the heirs can either turn over the property or they may want to retain the home, and they can work with the servicer to pay 95% of the appraised value of the home. So it does have some great protections. Now that you have a general concept of what a reverse mortgage is, I just want to highlight some of the most common uses. First of all, is to eliminate a monthly payment on a mortgage. So it's very common, probably 90% of the files I have, there is a current mortgage or line of credit for which my customers are making a monthly payment and are required to make one. So by paying off that mortgage, they have freed up that cash flow, that amount that they were paying towards that mortgage for principal and interest. So another very, and sometimes that's all people want is to get rid of their mortgage payment. There will could be reverse mortgage funds left over, but they may not touch those. And if they don't, it's going to be there for them. And that can be in the form of a line of credit for future needs. And so we talked about that growing line of credit. You may not need it now, but 5 years, 7 years down the road, there might be real need. And now that line of credit is larger and you can tap into it. A lot of people use it for long-term care needs. You know, once you retire and get to that age, it's impossible to get long-term care insurance. And so many of us have not provided well for long-term care. This is a great way to do it. Without depleting other assets, you can draw from the line of credit to pay for those monthly obligations, which could end up to be $7, $8, $10,000 a month. And the last one that's very common, is kind of an up-and-comer, is to use this program to purchase a new home. So it works very much like if you're going to stay in your own home, you come in with a down payment, and then we fund the rest with a loan that you never have to make a payment as long as you live in the property. Here are a couple other common uses. I mean, it's not hard to find ourselves in credit card debt these days, or have a car payment still. So a reverse mortgage is commonly used to just consolidate debt and pay it off and lock it into a program where you don't have that payment. Again, we can set this up on a monthly payment to you. So, you know, a number of my customers are only getting Social Security. They started in 1995 and they're getting $1,200 a month. To access home equity, set up a monthly deposit to them of an extra even $500 in that situation makes a big difference. It's a retirement planning tool, you know, especially when you're looking at retirement accounts where we've had those years where we've had depletion in those accounts. Instead of drawing from those accounts and depleting them even more, you can take a required minimum distribution from your retirement account, take the rest of what you need from home equity, and when that retirement comes back, you can even pay down the reverse mortgage, as we talked about. People are getting ready for the long-term care in their own houses by remodeling, making it age in place efficient. And so we do talk about covering healthcare costs with the reverse mortgage, as I mentioned before. Really, it's just a cash reserve as well for emergencies. Like we talked about, if you need to grab some money quickly, this is a way of doing it without having to make that monthly mortgage payment. Now, I've had some great customers who've done fun things with their reverse mortgage. I had an 82-year-old gentleman who he didn't have any kids, but that wasn't the issue because there's usually plenty of equity left for children. But he wanted to go and enjoy his life a little bit. So he accessed his home equity, bought a Hummer and a big trailer, and started heading east. And I told all my friends in Des Moines, Iowa, if you see a big yellow Hummer coming down the road pulling a trailer, just stay off to the side for a little bit. So I love it when people use their reverse mortgage to enhance their retirement. And of course, we talked about this idea of a purchase as well. So those are some of the common uses. There are many, many more. I've mentioned some of the safeguards with the reverse mortgage, but I'll highlight some more. We talked about it being non-recourse. That means you will never owe back more than what the home is worth. So even if you did owe more than what the home is worth when you leave it, there are no other assets that the lender can go after. It's only the home. And in those situations, the family usually turns over the home to the lender. You will always retain title. So that's a big misconception. That's something we're going to talk about in a couple minutes here. So you will always retain title as long as you own the home. It's yours. You can turn around and sell it the next day if you wanted to. So the lender never takes title to the property. Um, there should be, in most situations, equity left, and that belongs to you or the estate. So if you leave the home while you're still living, then and sell the property, you pay off the mortgage, whatever is left over belongs to you. Same with a situation where there's a death, the family will step in, usually sell the home, pay off the mortgage, whatever left over is split according to your estate planning. This line of credit I mentioned earlier can never be canceled or frozen or reduced. So it has that growth factor, which is really just one of my favorite features of the reverse mortgage. And then we talked about that line of credit growing. I hope you're comfortable with the general concept of the reverse mortgage now. And so now it's time to talk about the myths versus the facts. The number one myth, and it's been pervasive throughout the years, throughout the time I've been doing reverse mortgages. In fact, you can see my crow's feet from smiling through this one. It's a big myth that the lender is going to own your home or be on title to the property. The truth is, you will always be the title holder to the property. As I mentioned before, this is only a mortgage. So, of course, a lender is going to have a lien on your property for the amount that you owe back, but anything above that belongs to you. I think this myth came upon us from early versions of reverse mortgages before FHA got involved, where the lenders were feeling their way into this industry. And they thought, okay, we're going to allow someone to take out some of their equity without having to make a payment. But not only will they have to pay us back the loan plus the interest, if their home appreciates, we will be entitled to some of that appreciation as well. So someone might have only borrowed $70,000, but over the time of their loan, their house went up by $200,000. So they're asked to pay back $170,000, half of the appreciation plus the loan amount, and that was unfair. And that's why FHA got involved. There are no more of these equity grabs mortgages, and myth one is now officially debunked. Myth number two is that these funds that you receive from a reverse mortgage are taxable. Not true. We talked about that a little bit earlier. So it's just a return of your own equity. There, at the same time, there's no tax deduction for the interest that accrues on your reverse mortgage. So every month you're going to get a monthly statement showing you how much interest added on for that month. And you will not get a statement from the servicer on how much interest you paid unless you actually made a payment that included interest. And so there is usually a big interest payment when the mortgage is paid off. And you should always consult with a tax advisor on whether that interest will be deductible for you, because those tax laws change over time. But I can tell you this, the proceeds from the reverse mortgage are not taxable. Myth number three, reverse mortgages are risky and the funds that you qualify for are not guaranteed. That is not true. Not true, because once you qualify for it, it's available to you. Even if your home depreciates, that line of credit we talked about growing, that is a contractual part of the reverse mortgage. The reason that it's not so risky is it's backed by the federal government. So if for any reason your lender cannot provide the funds, which is very, very rare, as long as the federal government is in place, which we believe it's going to be there for a while, that you will have access to these funds. So you're not putting anything at risk. And myth three, debunked. Seems like I've been hammering on this myth that a borrower might owe back more than the property's worth, but That's a myth. And as you know now, it's a non-recourse loan, which means what? That you will never owe back more than what the home is worth at the time that you leave the property. Myth number 5, when the reverse mortgage is due, either the lender takes or sells the home and the heirs lose out on their inheritance. And as we talked about before, title is always in your name. So when the loan becomes due, which is when the last one of you leave the property permanently, if that's by death, your heirs still may receive an inheritance, any property value above what you owe back at that time. So, but should it be the case, and it does happen, but it's not very frequent because we're very conservative on our loan amounts in the first place. But if you do end up owing back more than what the home is worth, that is not your responsibility, nor your heirs. This myth is kind of might sound a little bit strange, that if a borrower outlives their life expectancy, the lender will kick them out of the house. Well, when we do set up a reverse mortgage, we use different factors to look at life expectancy. It's actuarial tables, but and you'll see that in some of the documentation, the amortization schedule, which is a document that shows you what could happen to the loan over time by adding interest. And we make some assumptions on there about your home's value increasing and whether there's ever a crossover point. But you'll see in documents, if you get that far, to even look at a proposal about what your life expectancy might be. I wish we could, that might be nice to know exactly, right? We'd live a different life if we knew exactly how long we were going to live. But if you outlive what our documents say about life expectancy, good for you. And you can stay in that home as long as you're possibly able to, as long as you're keeping the house in good repair, making your taxes and insurance payment, and using it as your primary residence. Some people believe that if you do a reverse mortgage, you're locked, you're in jail. You can't ever get out of that. Again, title, your name. You could sell the property the next day, pay off the mortgage. You can pay off the mortgage with other funds. There's no prepayment penalty, no minimum term, no maximum term. So that's this myth doesn't really come up too often because I think it's a general understanding that it is just a mortgage. Myth number 8, a reverse mortgage can impact my Social Security and Medicare benefits. That is just not true. It is not considered income. So as many of you might know, in Social Security, unless you're full retirement age and you can only work, have a certain amount of income before there's a reduction in your Social Security benefits. Well, that's income. The reverse mortgage proceeds is not income. So it will not have an effect on your Social Security or Medicare. Where it may come up is for Medicaid, which is often used for home health care. It's a federal program that is run through the states where you can get funds to pay for home health care. You may have heard about Medicaid being a common source of funds for nursing care stay. But Medicaid has certain requirements, and that's that you don't have a certain amount of assets, liquid assets in your possession. So the fact that you're getting an income is not going to affect those Medicaid unless you have too much accumulated funds in your bank account. If you want to learn more about Medicaid, I suggest that you contact your state's Medicaid office. Or even an elder law attorney to find out about those. But they will have no effect on Medicare or Social Security. Well, that about concludes my presentation today. So you might have those questions. Are you eligible? Well, let's talk about it. How much would you be entitled to? We talked about that being a combination of your age, youngest borrower, home value, and today's rates. So I can't just tell you exactly 50%, 40%. I would have to run your quick numbers, which is um, something I do very, very frequently. Give quotes, what the rate and terms are. And then, like I mentioned before, there's an up and comer where you can purchase a new home with a reverse mortgage. It's great for not depleting all the proceeds you might get out of the sale of your current home. Here's my contact information again. That please use me as a resource. It's all about education. And so if I can answer any of your questions, maybe provide you some alternatives to the reverse mortgage, I'd love to. And I look forward to hearing from you soon. So thanks for your time.